Hello everybody, my name is Christian Charlo. Welcome to your market report. Today we're Thursday, December 5th. Today folks, I want to make a follow-up on the last market report on November 29 when we talk about a movement in the gold sector and when we were expecting a movement in the financial sector. The gold sector was increasing, but that movement didn't last. So today I want to make a follow-up to tell you where we are right now. Well, first of all, on the TSX, on November 29, we were around this area, and I was telling you that if ever we had a continuity of that movement on the gold, and if the financial sector was surging, we might see the TSX clearly breaking its 13,500 resistance. That didn't happen. Actually, the TSX is clearly breaking down its support. So let's make a follow-up here. We have gold that is retesting the low of December 2nd, and gold might actually continues to go down. All this will depend, we think, on the employment report of tomorrow in the U.S. If we have higher jobs than expected, then there will be again speculation about a possible tapering of the bond buying program. And on December 17th, Fed officials will meet, and if they decide that, it will be totally negative for the gold sector. So gold have a lot of chances to actually retake its downward cycle, just like the gold sector. So let's make a follow-up on the stocks that we talked about. There was Yamana Gold, which was the best breakout on that first movement on November 29. It was a false movement. That movement didn't last, but still, Yamana Gold, you have to hold on to that stock because it has not yet broke that support at 893. So if you still have it, it's okay. Do not expose your portfolio to that stock. Still hold on to your position on that and put your stop loss below that support at 893 approximately. Lakeshore Gold was also breaking out, but there was a support there at 37 cents. So far, it's still a hold. It has not yet broken that support, but 37 cents, that's where you should put your stop loss on Lakeshore Gold. There are some stocks that didn't wash that were not that great. For instance, Argonaut Gold, yes, it was breaking out, but there was that downward trend that was there. So it was not one of my top picks. It was actually not my pick on Argonaut Gold. So Argonaut Gold, it's definitely a stock that you should have got out because the stock broke its support at 530. So it's a stock where you should have got out. Same thing also for ALAMOS Gold. Yes, we had a support that was there. Yes, we are reversing this downward trend. But what I didn't like with ALAMOS Gold is that this support here was not tested many times as compared to that support that's there. So ALAMOS Gold, you should have get out of that stock if you bought it. And I would say that on ALAMOS Gold, you would only get in if ever the stock reverse its downward trend. So I'm only a buyer on ALAMOS Gold higher than 1308. For the silver, we had Mag Silver. Mag Silver was the best breakout in the silver sector, but it was taking about 10 to 15%. So the strategy, I told you that first of all, you should put a trailing stop loss of 7% or so, and a first stop loss here around 575. That first stop loss had to be exercised if you did put it. And now the new point where you should totally get out of your positions in the Mag Silver, it's below 532 at this support. Pan American Silver was not a good breakout because there was all that resistance that's there. So far the stock didn't perform. So if you still have that stock, you hold on to it. For the financial sector, those, our banks posted strong earnings. A lot of them increased their dividend, but investors were kind of disappointed because of some technicalities in their balance sheet, because either their profit slept, or either they actually incurred more costs concerning some investments. So that's why Bank of Montreal is totally reversed its upward trend. So we think that on the long term, though, it's still just a moment to slightly reduce your exposure on that bank, but to not be in a shorting spree. National Bank, it's the same. It increased its dividend, meet analyst expectations too. So it's just a moment where we might actually have a rebound on National Bank because it's just testing its upward trend. And Bank of Nova Scotia also, it's the same scenario. Now, not all sectors didn't perform though. Even if gold and financials didn't perform, natural gas stocks today perform really well because of the GDP reading of the third quarter. They increase, and natural gas has been fueling the growth of the U.S. economy. So that's why UNG is clearly breaking out. So if you want an ETF to track that, there's HNU that is really nice. And also there have been other stocks that have been sending out like Advantage Oil and Gas. But what I don't like with Advantage Oil and Gas is all that resistance that's there. And also the stock is overbought. So I don't think that right now it's a good point to get in Advantage Oil and Gas. I expect a pause on that stock, and I'll get in higher than 467. Another stock is paid to exploration. That stock is actually nice, clearly breaking an important resistance. And two stocks that we recommended that we find are the best in the natural gas sector. We recommended them on marketgurus.tv that you can have access for free for 10 days just by clicking at the link below. Those two stocks are Berkeley Energy, that is clearly breaking out, and Cabot Oil and Gas, which is clearly reversing an important downward trend and also maintaining its upward trend on the longer term. So Berkeley Energy, we have a target until 875, but we believe that if it reaches 809, 818, it will be about 5 to 7%. So it's okay for us for Berkeley Energy. And we believe that with the good reading coming out of the GDP, it will definitely be positive for natural gas stocks, and Berkeley Energy will be able to benefit. So Berkeley Energy and Cabot Oil and Gas are our best picks so far in the natural gas sector because of the good data coming out of the GDP. So avoid getting in on your gold stocks, avoid opening new positions in the gold sector because there's still a heightened risk that they might go further down on the employment report that will be published tomorrow. So this is it for your market report. See you next week for your market report. This was Christian Charlo from marketgurus.tv.